Good afternoon, everyone. Thanks a lot for sticking around. Thanks a lot for having the paper on the program. It's really a pleasure to be presenting in front of such a distinguished audience and in front of an audience that is slightly different from the one I'm used to present at. So I'm really looking forward to your thoughts and everything that we find by looking at what the French insurance companies call a life insurance product, but which really isn't one. What I'm going to try and convince you of is that there still is some insurance going on, but instead of it being life insurance, it's really insurance against aggregate market risk that happens through some risk sharing across different cohorts of investors. There has been, and we've talked a lot about the secular backdrop in defined benefits pension funds throughout the world. Also, social security is at risk, and we've talked about that. Still, households demand savings products that are insured against aggregate market risk. They would like to know that they're not going to lose their money when the market collapses. The only way that anybody could hedge against aggregate market risk is actually to try and trade on financial markets through derivatives. But this is only going to be cross-sectional risk sharing. Somebody is going to bear the aggregate risk no matter what. The only way, there's this inherent market incompleteness that prevents different cohorts of investors, different people living at different periods, to share risk, which is that people cannot sit around the table and agree before they are born to share risks, aggregate risk later on. I'm going to take as given the findings of the public economics literature that say that there is a first best welfare improvement by allowing different generations of investors to share those risks. And what I will be interested in is how such intergenerational or inter-cohort risk sharing is possible and is actually at play in the product that I'm looking at. So I'm going to be interested in the optimal mechanism that Allen and Gale have shown to be that the intermediary that provides inter-cohort risk sharing should be building reserves, and that changes in reserves are going to accommodate asset returns and potential fluctuations in aggregate market risk, and that those reserves are going to be passed on between different successive cohorts of investors, and that's the way through which aggregate risk sharing is happening. But the findings of the existing literature is that this is not possible in a competitive environment. This can only happen if you have a mandatory public pension fund or if you have a monopolistic financial intermediary, because the minute you let investors freely trade on their products, they will not accept getting anything less than current asset returns. This is inherently impossible with perfect competition. So we are going to start by showing that even though in theory this is not possible, we do observe that different generations, different cohorts of investors actually share risks through the products we look at. We're going to show that at a macroeconomic level, this is almost 1% of GDP that changes hands every single year through those products. And so this is going to challenge the existing theoretical literature. Therefore, we're going to look at those intermediaries, those life insurers' incentives to provide insurance against aggregate risk. And we will show that the way they can do so is going to depend on a specific parameter, which is how elastic investors' flows will be to predictable returns. Okay? So I'm going to try and convey you the intuition. I won't have time to go through the theory today, unfortunately. But basically, the intuition is that inter-cohort risk sharing will only be possible if investors are not too elastic to the expected returns, and therefore will not arbitrage away the predictability that comes with this management of reserves by insurance companies. What we are going to be interested in is the conditions under which this is possible, and then look at the data and try and understand why elasticity of investor demand is not perfectly elastic. And we're going to relate it to lack of sophistication and show that thanks to lack of sophistication, insurance companies in France can implement this first best improving, welfare improving inter-cohort risk sharing at a large scale. Okay, so what am I talking about? I am talking about Euro contracts, which is the #1 savings product in France. It's sold by life insurers, but this is not a pure life insurance product, okay? Think of it as a savings product. It's a product that is widespread throughout continental Europe, and I'm going to try and explain to you how this relates to the products that are being sold in the US and the way in the US insurers are currently trying to provide a little bit of this insurance against aggregate risk, but in a very different manner. The assets under management are 1.4 trillion euros in France, which is a third of aggregate household financial wealth, the #1 million savings product. And there is a reserves mechanism that is actually kind of exactly what you would expect by reading the Allen Gale paper that tells you how intermediaries can implement inter-cohort risk sharing. So here's how it works. If I am to save in a Euro contract, I'm going to put down some money, and this is going to give me some account value with a given life insurer. Then the insurer is going to gather money from a lot of households, investors, and pool that money together and invest in through a common fund. The fund is going to have a stochastic return every year, XT, and at the end of each calendar year, the insurance company, the intermediary, is going to choose the contract return that it pays out to households. Okay, this is a discretionary choice by the insurer that is subject to some minimum guaranteed rate. In France, we don't have this issue that rates, guaranteed rates have been very high, and insurance companies are now have now problems paying out the guaranteed rates. Even though maybe 0% is going to become problematic in the coming years. The only restriction that they have is that intermediaries have to pay out at least 85% of asset returns, but they have discretion over the way they do it. What's very important is that they don't have to do it immediately. So this is going to give rise to reserves. Insurance companies are going to make some asset returns XT, but they don't have to pay out the entirety of those asset returns. They can put aside some in reserves that don't belong to them, importantly. They can pay it out immediately, but they can also put in the reserves. Of course, they're going to get 15% as profit, and here's what is going to work. Yes.
Most of this looks like what Bernie Madoff did. Is there any regulator that's actually guaranteeing that they're actually getting a certain return? It's
very important. So the mechanism that I'm going to describe, and we explained in the paper that it needs to solve a double-sided commitment problem. You need to make sure that insurance companies are going to repay whatever they owe to
Bernie said that too, but the common fund, is there any monitoring of the common fund? So I get the money, I put it in a common fund. Do I have to tell a regulator, I put it in this fund, here's the legal name of it, and then the regulator says, and here's the return? Because everything, Bernie said he was going to pay it off too.
Yeah. The regulator has access to which assets are being invested in.
Okay.
We can even observe it. So we know exactly what they invested in, what the fund invests in. Yes, I agree. Yeah. But it's important that the regulator makes sure that the reserves actually belong to the fund economic balance sheet to investors in fine and are going to be repaid. And that's one of the #1 things that you learn when you go to Bank of France and you become a regulator of insurance companies is how to make sure that all those reserves will be paid out to investors.
As an investor, can I identify which insurance company has higher reserves?
That's a very good question. I'm going to come back on it because that's going to be determinant to try and understand the elasticity of investors' flow to reserves and to predictability of future contract returns. But just bear with me for a second. Let me just explain what happens. This is the economic balance sheet of the fund that I was talking about, right? All investors have put some money in, and this money is being invested into some assets, and we know what assets they are, and they mostly invest in bonds, but they also can take advantage of the equity premium, and they have, I'm going to show you the numbers, they have 15% of stocks. But importantly, the reserves here, they belong to investors and not the insurance company, so this is different from equity of the company, of the intermediary, and they are passed on between different cohorts of investors. Therefore, what happens every year when assets pay off, some of it is going to be paid off immediately, on creditors' account, on investors' account. Some of it is going to go to the insurance company, typically 15%. And this is how you can have some cross-sectional risk sharing, right? I mean, the intermediary and the investors are going to share some amount of risk. This is what happens in the US when you have some guaranteed variable annuities. The payoff of the insurer will change, and the buffer in equity is going to be detrimental, is going to be crucial to tell how much cross-sectional risk sharing there is and how much insurance against aggregate risk there might be. But the novelty here is that you have those reserves that actually allow some of the asset payoff to go and to change hands between current and future generations of investors. So the very existence of those reserves, the fact that they're owed to investors and that they are passed on between current and future generations of investors will allow for inter-cohort risk sharing. And this is very different from what happens in the US, again, where Kwajin and Yogo have shown that there is some amount of aggregate risk sharing, but it's only between insurance companies and investors that can happen. You don't have anything like inter-cohort risk sharing in the US. So here's what the data looks like. On average account value in my sample of 76 life insurers is going to be 13.9 billion euros. They invest massively into bonds, half of which is sovereign, half of which is corporate. And they can take advantage of some amount of equity premium. Yeah, the inflows are 10% on average, and outflows are 8% annually on average. And when you plot contract return against asset return, you see this shocking evidence that asset returns are pretty volatile, but the returns that are being paid out are one order of magnitude smoother than asset returns. This does not tell us whether it's actual inter-cohort risk sharing. All this tells us is that there is some risk sharing happening against aggregate risk, right? Those policyholders, those investors are hedged against fluctuations in asset returns, but this might be due both to cross-sectional risk sharing between investors and the intermediary or to inter-cohort risk sharing. So when we look at what happens in terms of changes in the fund reserves, we see that all the fluctuation in asset returns are actually absorbed by fluctuations in those reserves. So the extent of cross-sectional risk sharing, the one that is happening in the US, is actually very low compared to the inter-cohort risk sharing that happens through those reserves and through the reserves mechanism that I've just described. So it's all the fact that investing in those products allows you to get a very smooth return that is not exposed to aggregate risk is only because you actually have some monetary transfers across different cohorts of investors happening. Actually, we do quantify the amount of inter-cohort risk sharing that happens on the aggregate scale. We are very careful looking at each investor. Say you have a contract return that pays 3% every year, and asset returns change from 5 to 0, and then 1 and 2. We know that there's going to be some of the transfer through reserves that is only within investor, right? Because you're going to hold your contract for multiple periods. Certain years you're going to receive a positive transfer from this inter-cohort scheme. Certain years you're going to contribute. And we net out in order to compute how much every single cohort of investor is going to benefit from this insurance mechanism. Okay? So the way we do it is that we know that every year the changes in reserves is going to tell us in aggregate how many euros are changing hands across and are going to current investors, right? If there is a negative change in reserves, that means that I am getting a higher return than what assets are being, paying off that year. All right? So then we look at how much each cohort of investor, what the fraction of each cohort of investor is as a fraction of the total account value every year. And then we look at how much net transfer each cohort is getting over its investment period by weighting by how much money was invested by each cohort in every year. We do not observe this data, so there's a lot of assumptions here in terms of the outflow rate, the inflow rate. We discuss in the paper how our quantification would be modified. So the number that I'm going to find I'm not sure this is the right number, you know, and that depends on the exact profile of inflow and outflows, but it's a relatively conservative number of how much, that tells us how much actual transfers are being happening in those contracts. And what we find is that on average, 1.4% of account value is changing hands through those contracts every year. And this is enormous because those contracts, again, are like the #1 savings product. We find that 0.8% of GDP changes hands across those contracts every single year. All right, so basically, this was sort of a shock to us when we first looked at this data because, you know, in theory, again, this should not be happening. What we know from the existing literature is that you can only share risks across different cohorts of investors, different generations, if the competition is not here. It should only happen if you force those people into the scheme, or if you have a monopolistic intermediary. So it has to be that competition is not perfect on this market, even though those are like markets that are, you know, freely functioning, so people can move from one insurer to the other, people can withdraw their money whenever they like without any penalty in doing so. So the question that we're going to ask next is, you know, how does that happen, and how can a model make sense of what we observe, and what determines insurers' incentives to smooth returns, and in turn, what determines and how can we explain the fact that investors do not seem to be elastic to the amount of reserves and to the predictability of returns that follow from this mechanism. Okay, so I wish I had a life cycle model to show you, but this is not what we do. It's mostly a banking model that I'm not going to show you today because of lack of time. The key parameter that follows from the model and is that the elasticity of investor flows to predictable return is going to be key in determining how much inter-cohort resharing can happen in equilibrium, right? If the intuition is really that if you have high asset returns a given year, and you as an investor observe that you're not being paid out the current asset return, you should withdraw your money from the fund, right? And conversely, if a given insurer has a lot of reserves that predicts future returns, therefore you should see all investors go to that insurer and dilute the reserves. And in equilibrium, except if investors' flow are not perfectly elastic, you cannot have inter-cohort risk sharing. So the model actually gives us two moments to look at in the data, and that's what we're going to do following, to estimate this elasticity of investors' flows to the amount of reserves that are being held in the panel of insurers that we look at. The first moment that allows us to estimate the investors' elasticity to predictable returns is by regressing the contract return that is being paid out by one intermediary J at a given time T as a function of reserves and current asset returns. Reserves are going to be distributed at a rate that depends on the intertemporal weight of each generation, and asset returns has a pass-through beta that will depend on how elastic investor flows are to the reserves. If investors' flows are completely inelastic, if investors do not invest in those insurers that have the highest amount of reserves and do not withdraw their reserves from insurers that have lower reserves, then we should see beta is equal to 0. If they were perfectly elastic, we should see that asset returns completely predict the contract return because the intermediaries could not afford not to pay out the current return. When we run this regression in the data, we find that consistently with the model, we find that reserves are being redistributed to investors every year, but the contract return that is being paid out by intermediaries does not depend on current asset returns. If anything, it depends negatively when we look at both year and insurer fixed effect, and this is more because of institutional details. You have some amount of guarantees that are very short term, But basically, this is consistent with investors being inelastic to reserves and to current contract returns. This is a puzzle because the amount of reserves that are being held with each insurer is actually predictable of future contract returns, just like the model is telling you. If you were to invest in a given insurer that has €1 extra of reserves compared to another one, you would actually make 2.5 more cents the year after, and you would have significantly higher returns for 5 years down the road. So we do look at an arbitrage strategy that is sort of, theoretically what you should do. If you were an arbitrageur, you would go long those insurers that have a lot of reserves, and you go short with those insurers that have low amounts of reserves. This would be a risk-free strategy, and this would give you an alpha of 34 basis points per year. So this doesn't sound like investors are behaving entirely rationally and as they should if they were actually maximizing their expected returns. The second moment in the data that allows us to look at investor flows elasticity to predictable returns is to look at investors' flows directly and how they respond to how much reserves are being held with a given insurer. And what we find is that there is just no action whatsoever. The amount of reserves that each insurer, each intermediary is holding is not predictive of any of the different flows that you could observe. It doesn't seem like investors invest their money with those insurance companies that have higher reserves, despite the fact that higher reserves predict higher contract returns. And we're going to go back to Alexander's questions of whether those reserves are predictable or not in the data when we look at the reasons why investors are or aren't elastic to.
Are they higher on average and also higher variance?
Say that again?
They're higher on average.
Yes.
Are they higher variance?
No, we show that this is a safe strategy. Investing in an insurer that has a higher amount of reserves does not entail higher risks for the investors.
Yeah, so you predict variance. You have a predictive model for average returns. You can have a predictive model for variance. You have a
No, we look in the data and we see that this arbitrage strategy that I just described has a beta of 0. So this is a riskless strategy.
That's not what I'm asking.
It's not what you're asking? Okay. We can talk again later then.
Well, no, the point's simple. You could actually estimate the variance, just like you've estimated the mean. And
oh, yes.
Yeah, that's all I'm saying.
Okay. Yes, absolutely. We can do that. Absolutely. But there is basically no evidence in both moments of the data that allows us to look at investors' elasticity to predictable return. We find that we can reject a value that is economically small. It would require a 70-fold higher elasticity to actually disentangle this mechanism in the data. So what we get from it is that investors' elasticity to reserves is nil, which means that investors do not seem to react to predictable returns too much. So the question we are asking next is, how are flows inelastic? Why is it that investor demand is inelastic, which allows intermediaries to actually set up this mechanism whereby they can insure investors against aggregate risk? Is that explained by taxes or the fee structure? This could be. So we look at the tax rate. We know that it decreases with the holding period, which creates a switching cost. And there are entry fees as well, which could offset the gain that investors could get from switching investors. New investors are not subject to any of those two caveats. Therefore, we look at what new purchasers of contracts do, and we still find that the purchases of new contracts and the investors' flows when they first enter the market cannot be predicted by how many reserves are being held by one insurer versus the other, which means that there seems to be something about this market that does not allow investors to actually play against this inter-cohort risk-sharing mechanism. It could be that insurance companies offset those predictable returns through fees. Yes?
Clarifying question. Are these products only available to retail investors?
They are only available to retail investors, yes. And we do not observe that insurers change fees to offset the predictable returns. So that seems to be that neither entry fees nor management fees change with the level of reserves at the time where investors enter. So there seems to be money left on the table by investors. So we are interested in trying to know what is happening and why, what are the incentives for investors to invest in one insurer versus the other, given that they are leaving money on the table and they don't seem to understand what's going on in terms of contract return predictability. And the hypothesis that we formulate is that maybe they lack the knowledge or the sophistication to predict contract returns. In order to proxy for investor sophistication, we just don't have data at the investor level. All we can do is we can look at the average investment amount at the contract level as a proxy for sophistication. So we look both across insurers and across contracts within an insurer year. We also have some anecdotal evidence about basic versus premium contracts in order to, again, try and proxy for sophistication of investors. And what we find is that indeed, both across insurance companies, across intermediaries, and within intermediaries across contracts, we find that those investors that have an average investment amount of more than 250,000 euros seem to be elastic to the amount of reserves that are being held with insurers. So what this means is that even though in the aggregate data we can find that investor flows are sensitive enough to reserves to destroy this risk-sharing mechanism, looking at the cross-section of investors, we find that those most wealthy investors do seem to have flows that are elastic to how much reserve there are. Therefore, they can actually get some return predictability. And so the economic magnitude is small, and it's not enough to disentangle the risk-sharing mechanism. So the last step that we do is that we try and understand why those wealthy individuals do not, the flows from those wealthy individuals does not entirely destroy this risk-sharing mechanism. So the textbook arbitrage strategy for wealthy individuals who seem to understand the mechanism that is going on would be for them to invest into those insurance companies that have more reserves, but for it to be riskless, they would have to short the risk-free asset because those contract returns again have a beta of 0. But the fact that capital income will be levied on the long position returns, but that the short leg of the portfolio is not tax deductible, means that there is a wedge between how much those wealthy individuals will get on the long leg of the portfolio and how much they would have to repay the short leg of the portfolio. And so we do some back of the envelope calculation to look at how much taxes they would have to pay on the long contract return, and we find that in line with the current actual capital gains taxes in France, there does not seem to be enough incentives for wealthy individuals to entirely disentangle this and destroy this risk-sharing mechanism. So what we observe here, and the elasticity of wealthy individuals to reserves, basically means that every time wealthy individuals decide to save more, they're going to be sophisticated, understand that they have to go to those insurance companies that have the highest amount of reserves, but they do not have enough incentives to actually disentangle the mechanism entirely. So this relates to vast literature that shows that, you know, in the US, those variable entities that have guarantees also implement aggregate risk sharing, but they do so cross-sectionally between insurers and investors. They do not do so across cohorts of investors. Any structured product, any derivatives, any product that allows some people to hedge against aggregate risk sharing means that there's somebody else on the other hand of the trade who is holding the risk. This does not make aggregate risk sharing disappear. This is only cross-sectionally shared. There's some amount of cross-cohort risk sharing happening maybe in defined benefits. It depends on the payouts of defined benefits in the time series. We know that in theory, intercohort risk sharing should not happen unless there is mandatory participation. But in this paper, what we have is that even though this is a competitive environment somewhat, investors' inertia or investors' lack of sophistication actually allows for this intercohort risk sharing mechanism. And this is a little coherent with current evidence that inertia allows for first-order welfare improvement in certain other markets, and this is also in line with the current banking literature that shows that investors in certain markets are not elastic to the rates that are being paid out. So to conclude, we show that financial intermediaries seem to be able, even in a competitive environment, to implement this risk sharing mechanism that allows different cohorts of investors to share aggregate risk, even though by definition aggregate risk is the risk that remains once all idiosyncratic risk has been shared, and it can only be shared away when you have different cohorts of investors trade with each other. In theory, it's not possible, but we observe that it is actually implemented on a large scale in France, but presumably in many countries as well, through this reserves mechanism, and that is sustained by low investor elasticity to predictable returns. So depending on how you want to interpret it, some amount of lack of sophistication actually in that setup allows for a first best welfare improvement. And just to answer Alexander's earlier question, the reason why more wealthy individuals are able to actually have their inflows elastic to how much reserves are being held, we can't exactly tell where this comes from, but this is in line with evidence in line with existing papers, and some of them by Olivia, who show that when some individuals can pay a small cost to actually access information and sophistication, they would do so, and that maybe that makes more sense for more wealthy individuals, obviously, to pay these costs of having an advisor who can tell them which insurance company to go to. This is how we like to think about it. Thank you very much.
Thank you very much. And we have
Thank you, Victor, and thank you all for staying and sticking around that long. So I'm discussing the paper on Euro contracts, which for me was a product that I had never heard before I read the paper, and it was very confusing in the beginning to me because I associated with another product that I know of, but I will tell you a little bit more in the next slides. So Euro contracts enable or share market risk across investor cohorts, and this result is basically something that speaks against previous theory and brings up like a Pareto improvement here for the investors. And Victor, in their paper, they provide a theoretical framework of intercohort risk sharing with imperfect competition in the savings market. And I'm not going to talk a lot about the theoretical framework or the model in the paper, which, well, you didn't really talk about that much either. But they do characterize how intercohort risk sharing depends on investor demand elasticity, i.e. the degree of competition. And they basically also show that the equilibrium level of intercohort risk sharing monotonically decreases from perfect to zero when competition increases from zero to perfect. I thought this paper was really, really well written, and I really liked it, and it was a very coherent and comprehensive model. So it was really challenging for me to even find something that I could criticize here. So I'm actually starting with a few things that I thought, or for me, were puzzling in the paper, and then afterwards I will say a little bit to their last contribution, which is the analysis of investor flow elasticity to reserves, which I think also you focused mostly in the presentation on. And in this respect, here just briefly 3 findings. So those are not all the findings that the authors have in the paper, but those are the ones that I will refer to, and that's why I'm putting them on the slides here. So investor flows are inelastic to the reserves, or the predictable returns, and low elasticity is more prevalent among the households who are expected to have lower financial sophistication, which you approximate with lower account values, and lower investor sophistication therefore enables better risk sharing across investor cohorts, which is somewhat surprising. Yeah. So just briefly, this is probably not the most accurate illustration of this product, but again, since for me the product was new, I tried to put it together in a way that it's just the cash flows here are easily understandable. So investors give some money to the insurer to invest into a fund. They can, however, withdraw them and reinvest here all the time. So there's management fees and entry fees, but you can reinvest into the same product or a different product and withdraw at all times. And then the fund returns, they go partially, this is regulated to the insurer, partially then into a reserves pool, and then partially back to the investors. And this reserves pool here is where the intercohort risk sharing takes place, because this then can go back to the investors, or has to go back to the investors actually, and basically the insurer can decide at what point in time this is happening in order to smooth the return here. Yeah, so again, for me, this product was a little bit puzzling, because they say it on page 16, despite being offered by life insurers, Euro contracts are pure savings products and do not entail insurance against longevity or mortality risk. So being German, I know the participating life insurance contracts, they typically entailed such insurance. So for me, I was basically, until, I think you mentioned it earlier in the beginning a little bit, that it's not a traditional life insurance product, which I thought, well, that means it has some fancy feature. And until page 16, I was waiting for some kind of death benefit or something coming in. So I think I would appreciate, at least from my very limited insurance in German perspective, maybe to put this more prominently in the beginning, to understand that this is really purely saving. And then I was wondering whether there are actually other different profit-sharing products in France with and without this insurance part. Because then you give some statistics, for instance, there's like, this is the market share and so on, and I think the insurer provision is like 80% of this product. And I was wondering whether it's just the savings product or the equivalent product also with the mortality or longevity protection here. So that was difficult for me to disentangle, and then I was wondering what would be different in your analysis for a product with such insurance. And I'm not saying you have to include this in your paper. I know this is not your focus, but this maybe is something that one could have in mind when asking the question, would this work in other countries, in other settings? Is risk sharing across cohorts therefore as sustainable in other countries, in other settings, if you consider these factors that might change? Yeah, and another point also, which was for me a little bit, as German, again, a little bit puzzling, but you stressed it actually in the presentation before, was that I would assume that the preference for insurer or contract could be related to different average portfolio guarantees, because you don't want to subsidize other people that have high portfolio guarantees when you enter such a contract. But then you also state that there were virtually zero, so in your sample they were typically not binding. And yeah, you said the average minimum guarantee return is 35 basis points. However, before I read that, I wanted to learn a little bit before about the Euro contract and the participating life insurance contract, how they're related and so on. So I was wondering about the minimum guareantees, and I went to IOPA's financial stability report here from 2018. to see what they say about the guarantees in France. So this is the report from 2018, but on the 2017 data. And you can see Germany here, yes, we're pretty high. But even when you look at France, it's at 0.75. And this is after the sample period. This is in 2017, and the sample period, I think, ends in 2015. So assuming that guarantees, portfolio guarantees have fallen, for me it was puzzling why this is double the size, basically. I couldn't figure it out until now. I think we have to compare the data in order to see what this is about. And then another question, like, would this work in a different environment, also related to the minimum guarantees, but I don't want to, stress this too much now, would be what is in the low interest rate environment, what would happen there if there was minimum guarantees that could be binding, or in general, you also have insurers that invest 80.5% of their, or if the fund is invested in sovereign and corporate bonds, and still here the average asset return in that period is very high, and the contract return before fees is at 4.0%, so they would even cover the higher portfolio minimum guarantee that we had in Germany. But I was just wondering, in that scenario, what could be the case, and I actually found a paper by Peter Hieber and others in 2015 who looks at these participation life insurance contracts exactly also in the situation what the role of the risk reserve is that allows the insurer to reinvest or to redistribute the profits between cohorts. So maybe you can have a look at this. Yeah, and then I said I'm going to look at the elasticity of investors' flows a little bit more. And I was wondering, you've shown that the investor flow are not elastic to predictable returns or reserves, which is super important because this is your main focus. This is where the inter-cohort risk sharing takes place. But you also concluded that they were pretty inelastic, and I was wondering, well, what is driving their decisions, right? So when they first invest into the project, how do they make their decisions? So maybe this counts more for new investors, because for old investors we have inertia, we have the tax reasons and so on. But it could be, for instance, a story like this returns chasing story of the Choi, Leibson Madrian paper of 2009 in the RFS. Just that people basically don't disregard the fees here, but they disregard the reserves. But there could also be other stories. For instance, it could be fees that play a role. It could be current guarantees. It could be the average portfolio guarantees, even if they're not binding, but maybe people have they just want to avoid subsidizing other people. And there's also, I've recently talked to Marianne Andriès from Toulouse School of Economics, and she told me about a project she's working on, which shows that people actually, if they don't have a model at hand, they just extrapolate the development of the past returns. So maybe that could be something. And I was wondering what information is given to them in the prospective. So how do they make their decision? And then also, have you looked at the role of sophistication just for new investors? Because I know you looked at new investors overall, and you looked at the role of sophistication, but the new investors without switching costs and tax distortion, maybe here it really matters whether sophistication plays a role. And then another one, have you looked at sophistication group sensitivity to redemptions? Because the inelasticity to high reserves for the people who have low contract value, so the people who are of low sophistication, basically, it might be due to liquidity constraints, so they actually cannot reinvest at the time. And then my last point, I think I'm running over time already, so the average account value. I was thinking, I think I didn't get that before, but in your presentation you said that you do not have investor level data. That's a pity, because I didn't see that before, because I think implicitly you're basically making the assumption that insurers can actually successfully target and separate the wealth group, so to say, and that means that if you cannot see the distribution of account values within the contracts, or the wealth within the contracts, then it might be that there's two big investors and a lot of small ones, right? And yeah, I think with your arbitrage slide you explained that a little bit, but then the question would be, how sustainable is the inter-cohort risk sharing if exactly those investors with high investment amount are sensitive to the level of reserves? And then the minor questions are just basically, you can look at them when I send you the slides, but I don't really want to go through them. Thank you for your attention.
Thank you very much. Yeah, so indeed a lot of what the comments you raised are about, things that we would do if we had at investor level data. I didn't know about that paper. I think this is probably something very minor. I have to check exactly how they do it and why they find different results. We find the same results as those people at Bank of France, and I played around with the data myself and collected myself, so I'm not too worried about what I did. I'm a little worried about what they did in Frankfurt.
You're a snob.
I definitely am. So I wish I could look at that, but this is not something I can do because I don't have this individual level data, unfortunately. I have to think a little bit more about your comment about liquidity constraint and the wealth of investors. And how we can do something about it. But yes, the best we have is contract level data. I'm going to have to think more about the rest of your comments, I guess. Do you have any questions from the audience?
So, going back to Irina's point about the flows, I think the product predicts, from a perspective of individual investors, very counterintuitive flows. The idea is that the return that you observe is the contract return, right? And you should exactly chase low contract returns to invest in them, but most of the prior literature individual investors actually shows that they focus on high returns. So if in a broad setting like this is a hard thing for them, right? Because it's like they should do the opposite of what they do in any other product.
Yeah, absolutely. So we know that investors chase returns. I don't have a table here, but I've looked at whether flows were actually elastic to past returns, which is what also practitioners tell you they should be, because it seems like there is a little bit of a game theoretic perspective as to when insurers post their current returns because they think that it's going to drive the flows. Maybe I don't have enough power in the data, but I don't find that in the data either. I don't find that investor flows are elastic to past contract returns.
Yeah, no, it will be hard.
Yes, they should only, according to the model, they should only be to the extent that they are going to affect reserves. Contract reserves are going to affect reserves, therefore future contract.
But they don't see the actual return, they see only the contract return.
They
The average investor.
They see the past contract return. Every year in October, each intermediary posts a prospectus saying our euro contract paid this.
But the asset return they don't see. They have to infer it somehow.
You can dig into the prospectuses, but they are very heterogeneous across investors. I mean, I even tried myself to try and see whether given I'm rich as snob, I should be able to know exactly. But comparing two prospectuses is kind of a nightmare already. So they don't make it easy for you. Yeah. Olivia first, and then.
I would take a little bit of an issue with your initial point that, quote, there's no inter-cohort risk sharing in the US, because there's one company, TIA, which is the one that covers all the academics, or a lot of the academics,
That's what I am.
which provides participating annuities. And the annuity piece aside, what they do is that they, you put money in and you must leave it in for 10 years, which is a form of inter-cohort risk sharing, because returns will fluctuate. Then they keep a reserve and they pay you out a minimum guarantee every so often. Usually it's more than the minimum. And so this is a way of helping people smooth their payouts over time. But the lock-in is important because it forces you to share across cohorts. Mm-hmm. The other thing that we've noted is that, I don't know how the Euro contracts work, but in the US there's two sets of books. There's the mark-to-market reserves, yes, which are reported to the regulators, and then there's the at-cost reserves, which are reported in some other fashion, and which are usually available to the participants. And so I'm worried that there might be different ways of reporting the reserves that might explain why policyholders are not so clear given the lack of transparency.
So I really appreciate your first comment because this answers to the question I get all the time, which is why don't we have that in the US? Because in principle here, the regulator makes sure that the reserves are being paid back. And my answer typically is that the double-sided commitment problem must be resolved, which is that intermediaries must be forced to repay the reserve, and also investors must be, somehow they are not elastic here. But you could expect that the market mechanism whereby I agree to enter this TIA contract and to tie my hands and not to withdraw my money when I don't get the asset return should happen, and actually it does happen. I didn't know about the participating annuities. I'll definitely look at it. And the second one, there are different sources of reserves. We do document in the paper that 1/3 of reserves are differences between market value and book value of assets. Economically, they are the same. Like if you were to sell your assets at the market price, you should be able to repay. But I agree that we do check that investors are not elastic neither to this type of reserve, which is accounting like a difference between market and book value. We also have what they call participation reserves, which are actually on the books and are reported. And you do observe that lately some insurance companies have been advertising those reserves to say we'll be able to pay out higher contract returns. But there's a little bit of tension with the regulator who is worried about what's going to happen to the insurance industry with the low interest rates. And there are that various types of reserves. It doesn't seem that any of those are investors are elastic to any of those.
Thanks for a really interesting paper. My comment relates to something that Irina said, and also just what you said just then about prospectuses. Have you looked at the papers by Bruce Carlin on intentional complexity that relate to the question of maintaining a group of unsophisticated investors in these types of market failures in order to keep a market share and maintain the profit of the provider? I think you might find them quite interesting. I don't know if they give you any leverage over your sophistication question, but I think for the context, they probably connect quite well.
It's very interesting. I didn't know about it, but this resonates a lot because we know that certain insurers, if you look at the cross-section of insurers, certain insurers would actually use to advertise the fact that they did not build up or manage any reserves at all, and that they would pay out all the asset returns. And typically they would attract more wealthy investors who are not interested into sharing risk with other investors. And some others are well known to be like the lambda investor insurer that everybody goes to, and that creates an enormous amount of restraint across cohorts because those people are not elastic at all. So I'm definitely going to look into that relationship.
So I'm still confused about this product. Why does anybody buy it? I mean, right, especially rich people.
Everybody buys it.
But why do wealthy people buy it? So you're not getting any insurance, you're not getting any risk point. There's got to be a tax game or something.
Yeah,
you're not really explaining.
So the reason why it's so popular is because you have a lot of taxation gains. In capital gains are much lower than what you would get on a typical mutual fund. And this is actually unfair competition for mutual funds because you can invest in those products and you get taxed much less on the returns that you make. But the question of why don't investors go to those insurers that have higher reserves and predict higher contract returns is actually at the heart of why there can be the cohort restriction happening.
But do you know that the insurer that has high reserves consistently always carries higher reserves, or is there some fluctuation in that over time? Because, of course, maybe my money's locked in for tax purposes for some number of years, but the next money that I put in could be in a different company.
The insurers do pay out reserves. So you do see mean reversion reserves. And your question was about...
Well, so with the tax arbitrage story, then I guess you have to leave your money in for a period of time before you get the lower capital gains. And I think you should model that, actually, because it's going to be differentially valuable probably to low-income people and wealthier people.
Yes.
But so if certain insurers always carry reserves, then that may attract a group of people. Whereas if it's kind of random, some do sometimes and some don't sometimes. Then you wouldn't expect much stickiness.
So I think in reality, it's a mixture of what you have in mind and what I've shown. So specifically in the presentation, I made sure that I showed you those cases in which investors should be elastic. But of course, in reality, there is also this tax scheme that forces people to stay in those contracts, right? So the reason why I look at new investors is because I know they are not subject to those tax incentives not to switch insurers. So I think in reality, it's a mixture of lack of sophistication and tax incentives not to trade on those reserves. And we do compute the tax incentives in the paper. We show that, we were wondering whether the government was smart enough to actually put in place a taxation system that would allow this intercohort restoring mechanism, but actually we find that even then there would remain some extent to which investors should be elastic and they are not. So it's like a mixture of both, really. Thank you so much for your comments, I really appreciate it.